on, guys? Welcome to Stock Talk with Nico Criticos. Today, we got a request to do an analysis video for Take-Two Interactive Software, and this is going to be ticker TTWO. So, the main thing going on with this company is that they have Grand Theft Auto coming out sometime in the next year, it looks like. This is saying it might be delayed, but it looks like autumn of 2025 is when it should be coming out. Anyways, there's a lot of hype around that, and so the important thing is that analysts have them, they're expecting earnings to do $7.69 for 2026. And as you can see, last year and this year, it's only 2.5. So we got pretty much a triple in EPS, which you would think should equate to about a triple in the stock price. And something like that is possible. But if you look at all the other factors of this company and their numbers, it doesn't show a strong picture. So first thing I always like to look for is revenue and net income. How consistent is it? Now, the revenue chart is not bad here. This one's not bad because this one, there's consistency. There's plenty of growth that has happened in the last 10 to 15 years. So the revenue chart is not bad. But where we have a problem is with the free cash flow, the net income. These numbers don't look good because here's the last 10 years. As you can see, they lost money in the past, and then they had a streak going here from 2017 to 2021 where they were making money, and they made $500 million in 2021. But since then, the earnings continue to fall off, and we go down to 400 million, negative $1 billion, and then last year or this year, negative $3.7 billion, which is insane. And keep in mind, this is going to have a huge negative effect on the company's balance sheet and their financial position, as well as we're going to check the number of shares that they issue or the money they're raising. That's also diluting shareholders and continuing to bring the stock price down. So keep in mind, they lost what, over 4 billion, almost over $5 billion of just in the last 2 years. Okay, their equity right now on the balance sheet is 5.6 billion. So not a very good situation here. Then we go to their shares outstanding, and this number keeps going up too. So here we got shares outstanding, and 10 years ago it was what? Right around 85 million, 100 million. Right now it's 170 million. So it has more than doubled in the last 9 years, which is horrible. And so that's going to continue to dilute shareholders. And honestly, the stock price is not as bad as the stock chart is not as bad as I would think. It's up 22% in the last 5 years, which that is bad. That's a huge underperformance of the general stock market as well as a bunch of other stocks. But really, I'm surprised it's up at all. Really, I'm surprised the stock's not at $80 right now because of everything going on. So the way I look at this is I would not invest in this company. I don't think this is a good company. I don't think they're in a good situation. However, with this whole Grand Theft Auto thing coming out in a year from now, let's say, if that does, which it probably will, if that does equate to let's say a triple, it's hard to predict these things, but let's say the earnings jump 3x like analysts have them doing, right? Let's say earnings go to $7.50. Okay, well, the way we're going to analyze this now is we're going to say, okay, so the stock price the stock price has been at this $140 mark or so for the last, that's probably like the middle line, about $140. So is the stock going to triple from there? Is it going to be over 300? I don't know about that. That's possible. But the way I would look at this would be, here's the PE ratio. In the past, it normally trades, it looks like at about a 32 would be a pretty fair number. So if we take 32 and we multiply 32 times 7.6, I believe their EPS is, yeah, then that's $243. Okay, and the stock's 160 right now. So that would be a pretty solid gain. That'd be a decent amount of money you can make if the stock was to go to that, which I wouldn't be surprised if a year from now this stock is about $250. I think there's a good chance of that happening. My thing is just, even though there's a good chance the stock will go up, at any point, this stock could come right back down just because of the situation they're in. And it's like, okay, if they have one good year, or they make a bunch of money for a couple months, or let's say they have a good quarter or two good quarters. Well, at some point, things are going to go back to them losing money, or they're gonna show that they can't be consistent with this, and then the stock's gonna come right back down. That's why it's so important to find something. You have to find a company that can show it's consistent with its net income and its revenue. So that will be my only thing. But if you're willing to take a chance on something like that, then yes, it is there is a decent chance that this stock will be $250 or so in about a year from now. And so again, if this stock were to fall more, let's say the stock came down to 130 or so, then okay, the risk to reward profile is a little bit more attractive, and there's less to lose in that situation. But really, I'm not looking to make like pretty much you're pretty much betting that their EPS is going to triple and that the stock's going to jump on that, which it might, but then it's going to come right back down. So that is my main concern with this, and that's why I would not interested in investing in this. But let me know what you guys think. Comment down below, and let me know if there's any more stocks you want me to analyze.